Hello, investors and traders, and welcome to the weekly market report. I'm Monte, Chief Technical Analyst with Sticky Trades. And before we get into the charts, I'd just like to point out that my analysis is something that we teach to all of our subscribers. And I have a 7-point trading checklist that notes all of the points and weighs the buy versus sell signals to find out whether or not the buyers are controlling the market or the sellers are controlling the market, and whether or not that is changing. And as you can see here from the daily candle of the diamonds as we come into the final minutes of trading, last week's market report, I highlighted this target down here with the end of that line being the price target. And as you can see, we hit that precisely on Wednesday. And if you had a chance to watch the midweek report, I said that we would most likely rally. The signals were showing a drop in volume on that day. The oscillators were starting to pivot up. And I said we would go back to test those highs. And that's exactly what has happened. Now, as you can see here from this little bit of a candle, that's known as a shooting star. We have a long shadow on top of that with a drop in volume. I'm going to get into the 6 tenets of Dow theory and why volume is so important. But when the volume is dropping on the way up, that tells us that the buyers are losing momentum. So next week, I do believe we're going to move back right towards this gap. We might even fill that gap all the way, but I think we're going to give back a lot of what we gained over the last couple of days. So my downside target on DIA is 388.67. If we move on to IWM, you can see here that my forecast from last week was hit right there. I did say on Wednesday that we would most likely bounce and come up to fill that gap. So we're moving up towards that gap. And again, we have a drop in volume. So for Monday, I think we are going to start moving lower. And I'll even put that into Tuesday, possibly Wednesday, to come right back and test the lows from Wednesday. So my downside target on IWM is 197.41. Now, this is all good news for swing traders, whether you're trading it from the buy side or the sell side. These price targets in these narrow ranges here help the traders know where to establish their risk points and where to start taking profits and moving out or back into position. So I get a lot of emails from traders thanking me for this analysis. Don't thank me, thank the charts. Just make sure you teach everyone how to manage risk, that's for sure. So moving from IWM to QQQ, you can see here that we did, in fact, fill the gap that was left last week. We did not come all the way down to this target. This is a longer-term target for the Qs, but for next week, because of that red candle, the drop in volume, I think we're coming right back down to this trend line right here at a 432.10 on the Qs, and there it is, the close of the market. And so for next week, again, I think that the Qs are going to pull back. Look at the hinge here on the CCI. See that? That's telling us that the momentum is actually shifting to the downside. So again, next week, 432.10 for the Qs. Moving on to the spiders, ticker symbol SPY. You can see here that we did hit that downside target again from last week. That downside target being 493.99. We hit that precisely again, went a couple of pennies over that, and then bounced off of this moving average. This red candle, like the other markets, are telling us that the sellers are starting to move in. So I'm going to get a little bit more aggressive with SPY. It might take a little bit longer than a week, but I'm going down to 498.67. Look at that hinge on the CCI. See that? That's almost an about face right there. So the drop in volume on the way up is bearish. The wide divergence from this moving average here is bearish. We have the gap below the market, which is bearish. Oscillators are overbought on the stochastic and hinging on the CCI down there. That's all bearish. And again, that goes back to what I was talking about with the trading checklist. You can see, again, I talk about the type of candle. I look at the volume. I look at the moving averages. I look for gaps. I look at these oscillators down here. And if you're brand new to Sticky Trade, just go to our website and you can pull that 7-point trading checklist up and use it yourself for your trade. Now, I want to talk a little bit about the VIX because we had a gap below the market that filled. And again, I talked about that on Wednesday. Now, we hit this upside target on the VIX, but we didn't come down and fill this gap. So what's happening now is the VIX is caught between two gaps. Now, on the opening on Monday, I think we could see the VIX drop down to fill that gap. Once this gap down here fills, the VIX now gets put onto the launch pad. And so what I'm going to do is just do a quick little two-part forecast on the VIX. I think we're going to come down, and then I think we're going to go right back up after that gap fills. So here's my forecast is to the downside. I'm going to put that down to the gap fill point. I'll match that up later as I adjust the properties. And then I'm going to get a little bit more aggressive with the VIX. This might take a little bit of time, but I think we're going to take out that high. So downside target is going to be from this low here. So that's going to be 1301. Fill that gap. It's going to rally back up to 1581. That's not unusual for the VIX to rally after downside gaps fill because that generally find some support. Now I do a couple of things here. SLV, I talked about that. SLV hit my upside target last week. I'm looking to buy it at this gap fill point. I almost put out a publication on X to buy back some of my shares of this, and that's a bullish engulfing candle, by the way, but I did not. Instead, what I did, and I rarely ever do this, but I want to do a shout out to our members and congratulations. We put out a trade publication on SVRA, and our members got into this one. This had a tremendous move today, up over 4%. And the reason I'm pointing this out for educational purposes mainly is because this is a symmetrical triangle. And so when symmetrical triangles are broken, it generally moves up in the direction of the height of the triangle. So this one has a good potential for a breakout much higher than this. And so if you do decide to trade this, even though it's a cheap stock, please make sure you manage risk. We pound the table on the 1% rule for managing risk. So be really careful that, you think, oh, it's just a cheap stock. What can I lose? $5. Well, you could lose 100% of your investment. You have to be really careful with that. Now, again, John Chow put out UNG. We've been following up on this one. John Chow, from one of our viewers, suggested this. We actually put this one out as well to our traders in the Power Pivot trading room, and UNG came right up to my target up here and then reversed and did an about face. Now, if you're trading natural gas, UNG, whatever it may be, oil, this gap will most likely fill, and then this one has the potential to get right back in, and we could do that all over again. I'm just, again, giving you my intentions and how we operate at Sticky Trade so you know how our trade publications get out and how our members are trading those to make money. And again, we always approach the charts from a risk management standpoint. So again, congratulations to all of our members who made money in these. And thank you again, John, for the shout out on the comments. Please like and subscribe and add those comments. I can't get to all of your stocks, obviously, but I can pick them out one by one and try to get as many of those as I possibly can when I can. Now, looking at some of the economic news here, this is something that's pretty incredible. Food spending is coming out of course, disposable income. Food, the cost of food as a percentage of your income is up to a 3-decade high. Now, obviously, that's going to put a crimp in the buying power of most consumers. And while we are looking at this market continue to rally because of a handful of stocks, the general heartbeat, or I guess you could say the pulse of the economy, is looking pretty weak. And so when again, thanks to Game of Trades here, I do a shout out to them. I pull a lot of charts on them. They have great research that they put out. You look at the amount of savings here on this particular chart, the big economic boom that we had that was fueled by, savings in bank accounts and such, those savings are now going negative. That is a very, very big deal and something to pay very close attention to. Again, looking at this, when you have less money to spend and the cost of food is going up, obviously that puts a crimp in the budgets of most families, especially young families who are trying to feed their children. Another leading indicator, I've talked about this maybe, 2 or 3 times over the last year. This is a leading indicator. And so when you look at charitable giving, now approaching the lowest levels in nearly 3 decades or 30 years, This is a leading indicator because people don't have that expendable income, or they don't have the savings to put towards giving to charity. So keep an eye on that, because that is absolutely a leading indicator that most of the financial programs fail to recognize. Another thing to keep an eye out is that mortgage applications are crashing. This is going to, I believe, lead to the big burst of the bubble in the banking sector and go beyond that. I think the fuse has been lit for a catastrophe here now. So credit is tightening up, mortgage applications are dropping as rates move over 7%. It becomes less affordable to buy houses. And you can see here that the purchasing index, which is that red line, is literally dropping like a rock. Now, I call this the countdown to catastrophe, where bad property debt now exceeds reserves at the U.S. banks. Don't believe anyone when they tell you we're not going to have a banking problem. It's going to start with the smaller regional banks and very quickly domino into a national and even worldwide catastrophe. This is my view, of course, based on trends that I'm seeing. So be careful in the market. While you see the market's going higher and you think all is good, watch out below, because it only takes one event to trigger a bubble that triggers many other bubbles. Now, you're hearing a lot of this in the news. How much would it cost to cancel student debt? Well, it's going to cost taxpayers a ton of money. Now, this is coming from Investopedia, believe it or not. And so they're looking to cancel this. Biden is outright ignoring the Supreme Court. And this is ultimately, if this continues to go out, this will cost, and this is according to research that came out actually a couple of years ago, it will cost every taxpayer about $2,500 per taxpayer. And that, again, add that to the lack of savings, add that to the inflation and food and other products, it's going to continue to mount up, and it's only going to cripple the American consumer. This is a fairly new phrase or term that's coming out, the U.S. stock market casino. Why are companies like even Bloomberg calling this a market casino? Because, like I said before, the markets are being driven by a little bit more than a handful of stocks. Lately, it was NVIDIA, out of control buying, irrational exuberance, as Alan Greenspan would put it. And this is only going to end very badly. When that bubble bursts, folks, I'm telling you, I've been in the markets for over 42 years. I've lived through every bear market since 1987. And I'm telling you something, I believe with my gut, it's going to be the worst ever. It's going to make the crash of 29 look pale in comparison. That is what I'm seeing. I've been talking about it. Now, like I said before, we do make money on the way up. There's a lot of trades that we made this week that we made money on the bullish side, but my longer term outlook is still bearish. Our option traders are still positioned with bearish put spreads long term, but we are funding some of these bearish positions with shorter term bullish positions, and we get out very quickly. Now, as I mentioned the week before last, the fourth tenet of Dow theory is where we need the markets, we need the transports to support or confirm what we're seeing on the industrials, and we're not seeing that. So when I talk about this being more of a casino, and others are agreeing with that, what that means is we're moving away from Dow theory. And that is a very dangerous thing, because if you look at what actually drives the markets are moving in trends, basically three trends, up, down, and sideways. But within those trends, we have what's called up legs and down legs, and the swing traders trade those, I guess you could say, the smaller trends within the bigger trends. And that's what I do each and every week when I put out price targets. Another thing you have to consider with the tenets of Dow theory is that the market discounts all news. So there's not really anything that's going to come out that's going to surprise the market as a whole, like we're talking about it as if it were a person, but the news gets out long before the price action. So the price action is reacting to the news before the news actually gets there, unless it's a stunning market report or an earnings announcement like what we saw in NVIDIA. But I'm talking about the general news that comes out is already discounted into the price. And what we're looking at here is volume. And that's what I talk about, again, in that trading checklist. That's number 2 on my list right here because I am following Dow theory. If you are too, then you have to look at volume because volume confirms the trend. If the trend is going up and the volume is going up, then that means that's a healthy trend. But as we mentioned this week, prices have gone up, but the volume is going down. So that's telling us there's a weakness in the trend. And finally, if the trend is intact and we see the trend lines intact, then the trend is most likely going to stay. But what we have to look for are the signals that define an end to that trend. And so when I look at the charts and I say, okay, I got my fan lines, go look at the Qs again. I have my fan lines in place that you can see right here on the weekly chart. I'll pull it back on the weekly chart. You could see that we have, these are accelerated trends. So this being the most extreme and more vertical trend on the Qs, if we start breaking out below that trend line, then guess what? That short-term trend is no longer an upward trend. So we would look for a pullback or a leg lower to the next level of support. So the general markets are getting very close to that. And if you stay in tune to my weekly market reports, I'll let you know when these trend lines are breaking and whether or not you need to take stronger actions with regard to managing risk. Folks, I hope you enjoy these reports. I certainly loved putting them together for you. Please like and follow and join me on X, formerly known as Twitter. Follow me on YouTube, and I will talk to you on the next video. Take care.